Good morning. Welcome to Fridays with Vistage webinars. Today, you're in for a real treat. We're going to talk about job costing, the nitty and the gritty, and our speaker is Dennis Najjar. My name is Bill Black, and I'm going to be your moderator today. I'm a member of Vistage International Group 1244 and the founder and host of the Exit Coach radio show, where I've interviewed over 1,000 professional business advisors and authors, including 100-plus Vistage speakers. In this webinar, you're going to learn how to determine whether job costing is appropriate for your company, how to identify key areas to implement improved processes, and the actual processes and technical procedures to bring back to your company to effectively integrate job costing into your management and reporting. For companies with more complex accounting and reporting needs, job costing is often looked to as a source of key financial insights. However, the actualities involved in effectively tracking and analyzing transactions for job costing can trip up even the best of intentions. This webinar will first discuss how to determine whether job costing is appropriate for your company, and then how to tackle the biggest challenges in implementing job costing. Dennis Najjar, the co-founder of accountingdepartment.com, has worked in public accounting since 1982. After graduating from Rutgers University in 1982, Dennis joined Coopers & Lybrand in 1986. Dennis started the public accounting firm Dennis M. Najjar CPA. His practice has an emphasis on tax planning and preparation for corporations, partnerships, and individuals. Throughout his career, Dennis has worked exclusively with small, medium, and startup businesses, giving him the knowledge and experience to oversee the accountingdepartment.com team in helping clients with strategic business planning for future success and growth. This expertise includes providing expert insights to leading publications such as Entrepreneur Magazine and serving as the resident accounting expert for the About.com accounting channel, where Dennis is the sole contributor of thought leadership and accounting guidance to business owners and CEOs. Founded in 2004, accountingdepartment.com provides comprehensive online accounting and accounting technology services for established businesses. Dennis, welcome, and please take it away.
Thanks, Bill. Well, I'm excited to be here and try to demystify this whole topic of job costing. So let's just jump right into it. We've got a lot of material to cover. Some of it's pretty heavy, as the expression goes, and some will be light, and we'll move past that at a quicker pace. But we'll spend some time on these more thoughtful topics that require some digestion. As Bill's already indicated, it is a key piece of information that businesses need to have when they're in the business of working on projects. So today's goals that we've heard in the opening remarks, let's just digest them for a second. Obviously, the first one is to determine if job costing is appropriate for your company. I think most of the attendees here already know that it is something that they want to do, but maybe they'll clarify a little bit on that. There are a number of challenges. We don't like to call them problems or obstacles. They're challenges in implementing job costing. So we're going to drill down pretty deep into those, give you the information you need to digest it on your end. And then we'll talk about some areas that you can improve, some processes that you can put into place, and then more importantly, give you some checklists, if you will, roadmap to go back and get things set up for your individual companies. So real basic. We'll start from the top in baby steps. Job costing is a method of tracking income and expenses. Everybody, I'm sure, has that as an understanding of what job costing is all about. Is it for you? Well, hopefully the attendees here fall into some category that might include consultants, architects, law firms, contractors, anyone who's working on some sort of time and material type project. Or more likely a fixed fee type of engagement for the services that they offer. Job costing is not likely necessary or used in retail or manufacturing businesses. They go in a different direction when they're trying to understand their financials beyond just the straight P&L. So if you're in one of those categories, you are in the right place, and let's just move right into the process. So we're going to break this conversation down into the revenue side, which I think we'll all find to be fairly straightforward for the most part. And then really the heavy parts have to do with payroll, to some extent subcontractors, to a larger extent materials, and even employee expenses. So those are the categories of things that we're going to dive into today. So what are the challenges? Well, the first challenge, of course, starts with tracking your revenue by your job. Now, that should be a fairly straightforward process as you're creating the invoice or possibly a sales receipt or recording a deposit, knowing where that came from and associating that with the job that it is for. So what's your challenge is posting it to the correct job. Set into place some process. Put together, you'll hear this a number of times, a document, something that gives instructions. Doing things verbally and expecting people to be able to follow that in your organization is likely to result in inconsistent application. So it's best to document the steps that you want someone to follow. So what are your action steps? Pretty straightforward. Determine whether a project should be managed as one or multiple jobs. So you have to first take a look at the work that you're doing for a particular client. And are you better served by breaking that down into smaller projects or treating it all as one? That's an individual decision that you'll make. I'd say that jobs that kind of stand on their own or projects that stand on their own are ones that you'll want to track on their own. And if you're kind of providing some sort of ongoing services to someone and you just want to be able to track the overall profitability of that relationship, would just be combined into one. For example, if you're doing a recurring service over and over again on a monthly basis, one job to track that profitability, and then you'd be able to generate monthly job profit and loss reports to see how your profit is running on a month-to-month basis, rather than trying to create a separate job for each month, for example. All right, and then of course one of the checkpoints you have to put into place that sometimes gets overlooked, and it's a simple thing, but it's an attention to detail. And that is when you do have some revenue type of transaction that you're recording, and if you set up jobs, well, simply you have to make sure that every revenue transaction gets charged to a job and that nothing gets charged to the what we would call the header or the main customer, where there's really no revenue or expenses. No revenue should be charged and no expenses will be tracked against. So there should be a process in there to review that on a periodic basis, preferably monthly, to make sure that something hadn't been misposted to a header account. Okay, so as I mentioned earlier, the four major cost categories that have to be talked about or analyzed are payroll, subcontractor costs, materials, and then employee expenses. But before we get into that, I want to talk a little bit about your chart of accounts. I've seen hundreds and hundreds of accounting files. We as a company deal fairly exclusively in QuickBooks, so I've seen hundreds and hundreds of QuickBooks charts of accounts, and consistently one of the things that I find is that the chart of accounts is not set up correctly. So think about the costs that go into delivering the service that you provide, the revenue that you generate. And all of those line items, all of those GL accounts need to be segregated into the cost of services or cost of sales section on the P&L. The easiest way that I like to define what those expenses should be is a definition as follows: that the costs that go into delivering the service are part of cost of sales or cost of services. So obviously your payroll for people who are performing the work. Obviously if you've hired some subcontractors, if you need to get some materials that go either they're significant or they're insignificant, those materials would be part of the cost of sales. One of the things that I often see is that wages are just lumped under a general category under G&A type expenses called payroll. And so you don't really get all the expenses pushed up to the cost of sales section that you need to have captured there. The T&E is another, common area. Generally, I find there's one T&E account, and that ends up being a combination of things for both the company's own travel and entertainment expenses as well as those that go or are related to the client projects. So you might have some duplicate sets of accounts to separate out those expenses which are directly related to generating the service and those expenses that go into supporting the service. And that's the definition of general and administrative. So the distinction is what goes into delivering the service versus what goes into supporting the operations of the business. And you'll see a little bit more about that as we get into payroll. All right, so action step, review your chart of accounts, look at all the G&A expenses, make sure that everything that should be up in cost of sales or services is already there. If not, you'll need to make some changes to that. All right, our first challenge is payroll. And this is the most complex one, and this is the one that causes the most angst. So I'm going to try to break this down into smaller bites. And there's really two main considerations in payroll. And they're often confused or combined into one, and they're really not. So you have to separate out timekeeping from payroll processing. Hours by jobs, keeping track of hours by jobs is the timekeeping component, and dollars by employee is the payroll processing component. So first let's talk about the timekeeping. So you have to kind of, do a little Zen moment here and flush your head of all the things you have in your mind right now about payroll being the focal point here. All right? So the solution for timekeeping is to select a timekeeping and a payroll service that will fit best for your company needs. So let's go through the considerations. Okay. So the objective in timekeeping, as simple as it may sound, is to compile the hours by a job. Now there's a number of considerations. If all your employees who are providing work are working in a physical office, then they'll be able to work from a computer where there'll be an internet connection. But if the services that you're providing take them out into the field and they need to keep track of their time, will that be something that you'll want to incorporate in the timekeeping method that you're going to have? Some businesses also want to do GPS tracking. So mobile access is the question. If you're land-based in what you do, then obviously mobile access is not too much of a consideration. But if you are out in the field, especially for the contractor types, then they will want to have a timekeeping system that will work with, and in some cases without, internet access. And the consideration there is if you are in an area where there might be limited internet access, you still need to be able to keep track of your time and be able to sync it back at some point in the future. So when you're looking at the different options, especially for a mobile force, knowing whether or not that's an issue will help prevent you from making the wrong decision. Now, in terms of how employees work with this, there's a couple of different things to kind of work through. The first one is, do you need to limit employee access so that they only see projects they work on? What does that mean? Well, there's a couple of things to think about when I put that in there. First is, do you have a lot of jobs? I mean, so what you don't want is your employees to be scrolling through a long list trying to find the job that they want or need or are assigned to, and conversely, making a mistake. So it improves accuracy if you're able to use a timekeeping system that can be constantly updated to push out the jobs that a particular employee is assigned to or working on or has available to them, as opposed to having everything. There's also issues of privacy. So do you want everybody in the company seeing every project that you have going on? So again, when you're talking to different vendors about timekeeping, these are some of the things that you want to take into consideration. Do you limit the roles your employees can choose? In other words, when you set up your timekeeping, you might have different activities that they need to perform. And again, you might have a fairly long list of those, and for particular employees, there might be a smaller subsection of that they would use because that's their job role. Again, if you don't have the ability to limit that, they're seeing everything, and you have the potential for mistakes. I mean, that's really what it comes down to, is mistakes. And then lastly, and most importantly, and my personal preference here, because this is the one that translated into my comments about where payroll ends up in your general ledger. And so when you think about how your employees are working, are they really doing more than one thing? Do they have multiple roles? And I'm going to suggest to you that most will. So what are the most common roles is you might be a direct labor person. So your setup of your chart of accounts is you may want to have payroll for direct labor, its own GL account. So that has to be a separate role in order for that to translate into a GL account. And you might have a project, and I'm sure many of you have project managers, a supervisor of some sort. So again, you want that to be assigned to a different GL account. So those roles kind of map, if you will, to different GL accounts. But the one that gets them tripped up is the non-billable time, the admin time, the overhead time. Well, PTO, for example, or sick time, or maybe they go for training, or there could just be some downtime where they're not able to charge for that. And if you really want to look at the profitability of your jobs, you have to pull that out. And that becomes an automatic additional role for each person. So now you're talking about mapping time to go to, or tracking time by different roles, so that later when we talk about bringing this into your general ledger, you're getting it to go to the right places. It's cost of sales for direct labor and project manager labor, and it's some G&A account for the administrative time that your employees have. Now, in the area of time approvers, a couple of things to think about when you're digesting or evaluating different options. One is, do you have multiple approvers for the same project? And if you do, then you want to be sure that your time tracking, your timekeeping system will enable you to have an employee track their time, pass it to some level person who does the initial review possibly, and then sends it off to a higher level person for final review before it makes its way towards payroll for processing. The more likely, a more common situation that I see is that there are multiple managers for the same employee. Let's say an employee is working on, just keep it simple, 2 projects, but each project's managed by a different manager. Well, what that translates into each manager needing to be able to approve that time for that person. They're responsible for that project. So having the ability to route the time sheet from one manager to the next is something that you would want to be looking for if that's something that's applicable in the services that you offer. And then the last consideration is, do you bill for your time? So when we talk about the payroll in a second, and I'm jumping ahead a little bit because I'm putting in something here about payroll processing, but when you get a file back, if your method of getting payroll into your QuickBooks file or your accounting file that you're using, your accounting system that you're using, is an import, you need to find out if that's going to have the ability to give you a trigger to capture that time if you're in a time and billing type of service and pull it through to an invoice. If not, then a payroll service producing your payroll is not going to give you this side of the information, whereas a timekeeping system that integrates, and again, I'll make some references to QuickBooks because that's what we have a high degree of knowledge and specialty in. And so there are a number of timekeeping applications that will enable you to bring the time in from the timekeeping system and mark it as billable so that it serves a dual function. It goes to the left so you can do the invoicing, and it goes to the right so you can do the payroll processing. Okay? So a lot of the considerations for the timekeeping part of this. So let's talk about what your action steps are. All right, so first you want to use a system that's going to integrate with your accounting system and the payroll provider. You don't want to be doing things in a timekeeping system that then has to be manually keyed into a payroll provider. Might sound like common sense, but we do see quite a few situations where there's some manual steps that are still being done today, even with all these tools that are available. The ability to have your accounting system as the nucleus is really, I think, what the focal point here should be. And if you read that next statement, what you see is the jobs in your accounting system will sync with the timekeeping system. Somebody has to be the master of all this information. So if you're going to use a timekeeping system, which you should be, you need to have an ability. You need to have the ability to update it on a regular basis. Not so much for the tasks that you want to track, but the customers, the jobs, who's assigned to what manager, all of those things. And the ability to kind of manage that in your accounting application and push that out to your time tracking system will ensure that when you get the information back, it'll import successfully. So there are a couple of timekeeping programs that we have used with our clients. I'm not here to endorse any of them. I just want to give you some names so you can go to their websites and look and kick the tires, if you will. Two that we've used, pretty much are the two that we've used a lot, are T-Sheets and Nexonia. The thing I want to mention about software in general is that when you go and you look at a couple of different products and you're going to say at the end of the process, I want a little bit from A and I want a little bit from B. Well, that's called a custom program, right? So you're going to have to look at the pros and the cons of the different canned softwares. And while you do have a third option to write something that's custom, that results in it being, of course, much more costly, and you have to continue to maintain it and development costs and all of that sort of thing. So there'll be some sort of evaluation process where you'll determine that one has most of what you're looking for. But some of you may already know from your own experiences that you never find software today that has everything that you're looking for. All right, so assess your needs, get some demonstrations of some timekeeping programs, and see if you can line up with something that will enable you to keep your time the way you need it. Transition point. Okay, so that's timekeeping. Now we're going to kind of move into the payroll processing considerations. So payroll's complex. There's multiple parts. We just talked about the timekeeping. Now we're going to talk about the processing side of it. So payroll services. This is very general. This is not specific to any company. The large ones, the small ones, the local, the regional, they all have a tendency to oversimplify what their capabilities are in the area of payroll processing for jobs, job costing. Now, many of them offer higher level services that are not what many businesses in our group range get exposed to. The cost of those, of course, is much greater. So your off-the-shelf products from the top national companies generally do not offer a job costing functionality. Trading up to their higher level systems will do that, but the off-the-shelf ones don't. So here's the issues. You get a payroll companies tell you they're going to give you a file that you're going to be able to export from their system and import into your accounting system. And I'll refer again to QuickBooks because that's what we use. I don't want to be too direct, but it doesn't work. There's a number of reasons for it not working. The first reason is you have to constantly give them updates on all those jobs. So again, there's no communications between the jobs you keep creating in your accounting system, QuickBooks in our case, and the jobs at a payroll service. So every time you create a new job, you've got to get that to them. So there's no sync. Any changes you make have to be synced. And since payroll companies generally don't have job costing capabilities, what they're actually doing is they're using another field that they have available to them. And the field that they're using is the department field. So maybe you may have already, maybe doing this now with your payroll services, you could have several departments in your company, and you want to track employees by those particular departments. So they're using that filter to give you the report back that way. So two things to be aware of. There's only one field for them to use, the department field. So if you're already using that and you want to add job costing to that existing payroll service, they're likely going to have a bit of a problem in doing that because they only have one field and you're looking to track the information two ways. But more often than not, you're not using the department field, and so your payroll service will say, yes, they can give you payroll by job, and they will then be using the department field and setting those up for each one of your jobs. Here's the issue. The first issue is that data is not going to map. You're mapping a department field with a customer. So you're going to have to manipulate. You're going to have to massage, reformat the export file that you're going to get from a payroll service to be able to import it. So it can be done. But there's a couple of other things that you need to be aware of if you decide to go this route or you're trying to go this route now. And so that's one of them, that you'll have to be able to massage the information to get it to import. The second thing that you need to be aware of is that you will not be able to split employees. Remember earlier I talked about roles that employees serve, and you might have somebody who's got some direct labor aspect to what they do or the manager, but there's also some admin part of what they do. And you want to be able to split that time so you can see the true cost going to cost of goods sold for their production time and of course their admin time going down as a G&A expense. Payroll companies can't do that. Because they're using a department field, they have to assign an employee to a department. And then it becomes a manual exercise of splitting them out to various departments. So something to make sure you question when you're looking at this as your option. And then the other challenge with payroll services is that while they can departmentalize the payroll to something you call a job, they do not have the ability to job cost the payroll taxes, to split it out. So the big component here is you just don't want the wages allocated. You want the taxes that go with it allocated to each one of those jobs. So they're not going to be able to do that. If you ever saw a payroll report, maybe one that had departments in it, and you looked, there's no payroll taxes by department. The payroll taxes come at the very end when they give you the grand total of what are the employer expenses, and that's just a function of how that happens. So if you go that route, then we're not going to get an automatic full job costing on the payroll expense side. What you're going to have to do is you're going to have to, again, massage the information, do some sort of an Excel spreadsheet where you're going to allocate it as a percentage to all the open jobs for that pay period. These are all manual steps. What we're really trying to get to is an efficient, timely, quick way to keep track of all this information so that you're getting good reports. If it takes you 3 weeks at the end of the month or 4 weeks at the end of the month to go through all of these steps, well, the information is pretty old and cold at that point. So while it's not necessarily real time, it is a lot quicker if the information can come to you ready to go. So make sure you ask all of those questions when you're talking to your payroll provider about giving you job costing information. Now I want to talk a little bit about some of the considerations because I mentioned QuickBooks a couple times here, and while we use that a lot for clients that need job costing, you'll kind of understand. And there's some cons that go with it. So it's not perfect. Nothing is perfect. Just like I said before, when we evaluate different software options, you'll find that there's going to be something that you wish you could take from each product that you look at. So the Intuit solution, as far as we're concerned, really gives us the best ability, can give you the best ability to do this piece of it, the heavy lifting on your payroll. So here's what's going to happen. QuickBooks is the nucleus. You set up all your jobs. You set up all your roles in QuickBooks. You set up all your billing codes, all of that information. You connect that to a timekeeping app, time tracking app. And so every time there's updates, new customers, new roles, new jobs, new employees, that information gets synced out to the time tracking application, and those employees can go about keeping track of their time, whether it be on their phone or on their desktop. At the end of the pay period, that information comes back. It's synced back in, and it can be, as I said before, sent to the left if you're doing time billing, time and material billing. If not, it just accumulates for the payroll purposes, because the second thing it does is it goes to the right, and it heads over to the payroll module. And now it populates the payroll module. Then within QuickBooks, because you've assigned the jobs, and if you're using classes, you can use classes as well. That's a function within QuickBooks for departments if you needed to track by different divisions, commercial, residential, if you're in a contracting business, for example. And when you process payroll, you get fully job-costed payroll tax expense. So everything gets charged out to where it belongs, all synchronized within the QuickBooks, which is that nucleus. You can even map it to the different categories. So we talked about before, cost of sales and administrative. That's all part of the codes that are set up. So whether you're using QuickBooks or not, these are the kinds of things you need to be looking for in your solution. So whatever your accounting software is, kind of visualizing it in this flow in which your accounting software is managing it and feeding it out to a time tracking and then populating it to a payroll service, whether it be one that's in your accounting, built into your accounting software like Intuit is, or using a third party that can integrate with that same data. Because those programs will feed to third-party payroll services as well as others that are out there. Okay? Now, so what's the downside to QuickBooks? Well, there are two. I'm going to be very upfront about it. One of them is that, it doesn't have an HR module. So, a big push today especially with the national companies is they're offering some HR services that go with it, and now with the ACA reporting. So, starting this year, I guess it is, 50 or more employees have the same requirements as 100-plus employers, I should say. So you're not going to get that capability within QuickBooks to manage your HR or your ACA reporting. There are solutions that will do that, but again, now you're talking about something external. So you have to weigh the pros and the cons. That might not be a big deal to use a third party for those features, and have to streamline this whole job costing of your payroll. And the other side to it is you are handling the payroll. While Intuit does handle the taxes just like the large companies and the small companies and does file all the tax returns, there's a little difference. What's the difference? Well, you communicate your payroll to a payroll company, and they have to do all the data entry. They make the mistake, it's their fault. You get to go and yell at them, right? If you're doing it internally, well, that's your employee that's made the mistake. Didn't hit the right code or didn't have the right deductions or whatever the case might be. Forgot the garnishment, so forth and so on. So you do need to have somebody that is capable, is qualified to understand payroll and be able to run it. You don't have to be worried about taxes or payroll forms because that's all covered. Now let's compare that to a third-party payroll company. So your time is going to be imported from your timekeeping system to the payroll service. Right? You're going to make sure that happens at a minimum. The pro, of course, is that you will more than likely have available to you options for HR services as well as ACA reporting services. So those are two important things to think about. And then the list of cons, which is really a summary of the things to ask, are the steps you're going to have to go through to format that data when you get it in order to be able to import it. More than likely, you're going to have to manually allocate the payroll taxes. If you are using, in my example, the department field already, then it might be a challenge to add job costing at the same time. And then there's the limitation on being able to split the wages between different GL accounts, splitting the employee between different departments. So I think your action steps or your to-do is pretty well laid out for you now. Decide which one really is going to work for you, and if it's the third-party payroll company, then you need to make sure to address all of those items. Success. We made it through payroll. That was the hardest part, believe it or not. Well, some of the other parts are difficult. This is the one that really kind of twists your mind a lot to understand that there's really two things going on, that timekeeping component versus that payroll processing component. So if you're still with me and you still want to continue on with job costing for your business, here we go. Let's talk about our challenge number 2, subcontractor costs. And so in this area, you're dealing with, in many cases, you're not only have employees doing some of the work or maybe exclusively having subcontractors do some of the work. You need to get that information from them. Now, this one is fairly straightforward to put into place. And I'm going to actually jump to my next slide, and I think this will really summarize it because we've got a bit more to cover, and I'm coming up on a quarter of the hour. So I'm going to give it to you in a nutshell. You need to create a standard operating procedure, an SOP. You need to, like I said before with employees, in terms of making sure that they have a process to follow, you want to make sure there's a process for everything in your business. And so this is a perfect example. Even though these are outside contractors, you want to give them a standard operating procedure that you expect them to follow. That gives you what you're looking for in order to facilitate this. Create a checklist on your side to make sure that all the vendor costs are accounted for. It's part of a closing process you would have to go through at the end of the month to make sure that when you're getting ready to report for the period that you have everything accounted for. And then kind of a subtle thing, which, I look at a lot of QuickBooks files, and there's something that is not going to jump out at most people when they're looking at reports in a QuickBooks, for example. So if you are using QuickBooks and you are using job costing, here's what I want you to do. I want you to go and run take the period, whether it's the month or last year, it doesn't matter. Take a period and look at your company P&L. And then I want you to also pull up next to it the P&L by job for that same period. I want you to go all the way over to the end where you see the total column. And I want you to compare line by line, revenue line by revenue line, cost of goods sold line, gross profit line, to that totals column between those two reports. I would suspect you will find differences. And those differences are simply transactions that have not been assigned to a job. So what's the implication to that? The implication to that is, well, you think your books are closed, and you're given a job report for a particular project, and you're looking at it and making decisions about what's going on with that project. What you haven't been able to, haven't been aware of, I guess is maybe the best way to say it, is that there are transactions floating around in your ledger that have not had a job assigned to them. So effectively that renders that report useless, that job report, that individual job report. What I would suggest you do is consider setting up a needs job category, or customer, I should say. And so every transaction that comes in that you don't know, or your internal staff don't know what to do with, have them assign it to a needs job. What will happen then is, if you make that, like, say, for example, Z needs job, it'll be all the way at the end right next to that totals column. And when you run that report, you can instantly see the dollar value of all the transactions that have not been assigned to a job. Now, you can figure it out with the method I just gave you by looking at two different reports, but it still has to be fixed, because whether you're looking at two reports or you're looking at a column that says, here's everything we didn't put a job on, you still need to assign those to a job in order for those individual job reports to be accurate. So I think your path here is a little bit easier than payroll. Set up a procedure for your vendors, give them something to follow, have some sort of internal checklist of what needs to happen at the end of the month with each of the vendor relationships when you're using subcontractors, and then set up a needs job customer to help track those expenses that somebody needs to go back to and reassign. Okay, we're going to talk about employee expenses next, and this is an interesting one. I find it interesting, at least. And my interest is in how the software companies have adapted to the needs of businesses. And so, everyone knows expense reports, I should say. And there's been expense reporting apps for quite some time. Many of you may be using them. Some may still be using Excel as your method of keeping track of employee expenses. If you're using an application to track employee expenses for reimbursement, they've now been modified to allow you to connect a company credit card to an employee expense account. So if you have an American Express and you have 10 cards, because that's what American Express does, they give you a separate card for each employee you request one for, those individual accounts, even though they're all reported on one statement, can be connected to individual expense account and expense reports, the account for an employee in an expense reporting app. So whether you have out-of-pocket expenses or not, the point is that you can now not only use them for expense reporting to give money back to employees, but you can also use them to facilitate job costing. Because if you think about it this way, we're going to hook up an American Express account to an employee who's in charge of an account or a number of accounts. And they're going to go out about the day and they're going to be making purchases. So what's the challenge? Well, at the end of the week, or maybe even as late as the month, you get the American Express statement, and then you start trying to figure out what's for what. Who did what? Who charged what? Asking them, going back to them, asking them to fill in the blanks, so forth and so on. It's a laborious project and process, and often results in some stress and strain and things not actually getting done. This is one of those weak links in the job costing area. So by hooking it up in a real-time way, they can be fed their transactions. It takes a day or two from when you charge something on your credit card to actually post as a transaction, and then it would sync automatically. So if they developed a process of syncing looking at their synced transactions on a daily basis, and then submitting an quote-unquote expense report, they could be looking in pretty much real time for the transactions to assign to different clients or jobs that you want to be able to track from a job costing perspective. They could also be doing this, of course, with their out-of-pocket expenses, and that would be submitted as well. These programs have the ability to separate. They're not going to be reimbursing your employees for the credit card charges that you're paying. So it gets synced into your accounting system, and part of it goes to the left, to the credit card liability account, and the other part of it goes to the right in terms of an expense report that gets created into accounts payable and then runs through your accounts payable process for reimbursement. But the key element here is that you're giving them more information sooner to get those jobs assigned so that you're not chasing somebody later on. Now, these expense reporting tools have other benefits, and they're listed here, or things for you to consider, but there are also benefits. If you need to split between multiple expense accounts, or you split expenses between multiple customers, those are things to think about. Of course, the cost is a consideration, and the ease of use are things that you need to assess as well. But I think if you take a look at this area, if it's significant to your business where you have these kinds of charges that somebody's running around trying to figure out, this could be a solution to get that information tagged a lot quicker. So you've got your your solution. Again, I'll mention a couple of the products that we use currently for clients. We use something called Expensify, Tallie, and Nexonia. You saw Nexonia previously when I talked about timekeeping. So that's kind of a common one. Clients like that because it does two things. It'll do time tracking, it'll do expense reporting. It's one application with two different components to it, and so there's some appeal when they have a need for both of those. So your action steps are listed there, and you can put something into place. Now, in the area of materials, so this is that other pain point that I know many businesses have, especially in the contractor area, where you're buying bulk materials, or you're buying from vendors like Home Depot or the regional home improvement stores, Menards in the Midwest, those sorts of things. So you've got common kind of issues here between bulk materials and vendor account. I'm just going to flip over to the next page because this really is going to kind of take us to where we need to go in the conversation, rather than just verbalizing. You can kind of see it as well. So a couple of different options you can evaluate. Again, these are options on how you can handle it. It's a common problem. What do I do with these materials? So the two that we use with our clients, and it all depends, again, on what their level of commitment is to this area, how significant these costs are in terms of allocating. But the two most common ones that we've come up with is to treat bulk materials sort of like inventory. Now, I don't mean it's inventory in the sense of you're selling it, but you can use the inventory function within your accounting application to track bulk goods that you receive. And then you would develop a requisition form. Now, this works best where the materials are in some sort of common place, a warehouse, for example, and your guys would come and requisition things. So you'd have a requisition form, and, it would list the 10, 15, 20, 30, whatever number of items you might have. And they would, the warehouseman who doles out the products, check off what they were given, and then on some recurring basis, submit those to accounting, who would then run an accounting transaction that would effectively relieve that from inventory and charge it to the job cost on the P&L. Now, that's not for everybody. And so the other method that we come up with and have used with our clients is kind of an option B, is to allocate it as a percentage of the job. You could pick some figure in your job costing, and that becomes the percentage at which you apply it against. So if it's revenue, if it's labor, some element of your revenue or expenses becomes the figure against which you come up with the percentage and then apply it that way. And so you apply it against the jobs on a monthly basis to get that cost over there. Vendor accounts are similar. You kind of visualize what happens with Home Depot, right? Your guy goes to Home Depot, you got a Home Depot account, and they just keep charging stuff, and at the end of the month you get the statement, and it just says purchase, 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 purchase. Nobody ever has the details, and, before you know it, you're scrambling around to figure that out. So some of these expense reporting applications can be connected to credit cards like a Home Depot. You could use the percentage method allocation that we talked about, or you could give different cards to different managers and kind of make them more responsible that way. So breaking it down into smaller pieces. All right. So.
Hey, Dennis, this is Bill Black. I'm going to jump in here.
Yes,
We're getting close to the end of the webinar, and I know you just have a few more points to cover. So maybe you can get through those in about the next 3 minutes, and we'll be right on time. I'm
going to supercharge you. Thanks, Bill. Okay. So next topic I want to talk about real quick is the 3 methods of accounting, and I'm going to leave you to read all this and get right down to the nitty gritty. Everyone's heard the terms. There's a cash method of accounting. There's a modified, maybe you've heard there's a modified cash method of accounting. And, of course, there's the accrual method of accounting. The long and the short of it is when you go through all of those points, that if you're going to be doing job costing, you need to run your books on the accrual method of accounting. If you don't run your books on the accrual method of accounting, you're only getting what came in or went out on that particular month. You need to be able to capture things like prepaid expenses and accrued payroll. You have to track deposits and deferred revenue, and most importantly is the topic of work in progress. And in the area of work in progress, I'm going to skip over these because we talked about them, is making sure that you're calculating it. So there's three key areas: your income, your cost, and most importantly, your percentage of completion. Those are the key figures that you need in order to calculate your work in process. And I have an example that we put together that's in the materials, and it's very easy to follow because I went ahead and put some bubbles and showed you how all the different figures came up. But effectively, on the left, we have just what came in and what went out, and it gives you a false reading of a 70-something odd % gross profit on that project. But when you take into consideration the actual work completed and apply that to both the revenues and the expenses, you find out that you're running more along your 40% range. So it's important to apply these principles of calculating your work in progress and using all of those accrual types of transactions, making sure those are all part of the equation before you start drawing any conclusions on your jobs. And that's it. I got it in there for you, Bill. Thank you.
Hey, that was a fantastic job. You know, you took what is a very complicated and complex topic and really gave us a lot of ideas, Dennis. And we had some great questions, but you covered the questions. And, of course, if you have additional questions, why don't you put up your contact slide? I think that was at the end there, Dennis, so people can get in touch with you because, you know, this might be the beginning of a decision for a lot of people to find out a lot more information. So go to info@accountingdepartment.com if you'd like any of the things listed on the screen. There are tons of information there, Dennis. Very nice job. Thank you so much.
Thank you, Bill.
I want to remind you that Fridays with Vistage continues next week, Friday, May 6th. With How to Find Great People, Recruitment is a Sales Process with Kathleen Quinn. I'm looking for her last name. I'm sorry, Vota. She's a speaker. Kathleen Quinn Vota. She'll be a tremendous speaker. You want to log in and check that out. And also Friday, May 13th, Front of T-shirt, Back of T-shirt, a framework for self-awareness by Mike Zani, who's the speaker for that. Fridays with Vistage is a tremendous resource and tool. I hope that you will join me in congratulating Dennis Najjar for putting on a fantastic workshop today, and I hope you'll join us next time on Fridays with Vistage. That's all for now, and thanks very much for joining us.